All right. So today we're going to talk about the credit crisis occurred about 10 years ago, a little over almost 15 now, and how securitization played a role in that. And so to begin with, let's just talk about what we mean by securitization. So traditionally, we teach banking theory, that type of thing. We say that you'll receive these deposits, and then you take those deposits, place it in your reserve, and then you can take a percentage of that. You have a reserve requirement that you're required to keep aside, and then you can make loans with the rest of it. Well, what securitization would allow is, instead of dealing with a loan and then I have assets against that loan, I could take those loans and repackage them as their own investment securities that people could then go and invest in. And that would move them off of my books that much faster, which allowed me to make more loans because my reserve requirement was continuing to drop. So this is the motivation that led to more and more loan securitization. This is just an example. Obviously, in the real investments, we would have many more types of tranches. But as you can see in this diagram, you would just take all of these various assets. So these could just be home loans from around the country or whatever. You see the assets, if it's a debt, then we'll talk about it as being this debt obligation, like a collateralized debt obligation, a CDO. But mortgage-backed securities are MBSs, asset-backed security, you'll hear ABS. So they could be consumer credit. We're seeing that happen there as well. So basically what will happen is you'll take all of this like portfolio of assets, create a special purpose vehicle. That's what that SPV means. So we create a special company basically to hold all this. And then that SPV will pay out. The majority of it is for the senior tranche, right? So these are the ones that get paid first. And if you notice, their return is LIBOR plus, 60 basis points, so not a lot of return. The next tranche down, the mezzanine tranche, and I'm not sure exactly why tranche was used. It's just like trench, but that's just the word that we use. So the mezzanine tranche, that middle group, less principal is put there. And if you notice, since they're getting paid later than the senior tranche, they're going to get LIBOR plus 2.5% or 250 basis points. So they're receiving more money because there's more risk because the senior tranche gets paid first. And if you notice the last group there, the remainder is the equity tranche. And these are people that are really just trying to get a higher return. So they know that they're bearing all of the risk, but they're going to get paid a lot more on the back end from the money that does come through. So this is a simplified way of thinking about making these asset-backed securities. And so when the cash flow comes in, so if these are mortgages, then whenever people are making their mortgage payments, when that money comes in, it first goes to that senior tranche. It would then overflow into that mezzanine tranche, which is a bit smaller. But then once it fills that up, then the remainder goes to that equity tranche. So obviously the people at the equity tranche are the last to get paid. So they have the most risk in their cash flows, but they're also receiving the highest return on their investment. So it's the risk to reward that we're used to. Okay. And so once they have these asset-backed securities, we could then make collateralized debt obligations out of those asset-backed securities. So this is where it starts to get more complicated. Of course, then this is still simplified a bit. But if you notice, the senior tranche, we've gone out, had it evaluated, and it's AAA rated, meaning that it's extremely secure in the eyes of the ratings industry. The mezzanine tranche is BBB, which is still an investment grade, but it's higher risk. And then the equity tranche, they don't bother getting a rating for something like that because we know it's got all this risk, right? So we don't have to worry about trying to get a rating. But the higher ratings are important because that will allow for like a pension fund, right? Somebody that is restricted in the types of investments they can make. By having this rated, then they can say, okay, well, this is safe enough to represent this much of our portfolio in this pension, right? So, so that's why they go through the trouble of rating those. But as you can see, we could take that mezzanine tranche from the asset-backed security and then create collateralized debt obligations off of that, right? And then if you notice, the senior tranche itself can still be AAA rated. The mezzanine tranche of the mezzanine tranche is BBB, and then there still would be an equity portion that would not be rated at all. So as you're seeing, we're nesting these within each other. The reason to have it set up in this way is just to better define cash flows so that you would have particular investment markets. So the person that would buy the senior tranche of the asset-backed security, right, the people that would be receiving that would be different perhaps than the people that receive the senior tranche of the collateralized debt obligation off the mezzanine. Even though they're both AAA rated, it has to do with the nature of these cash flows. So they would have potentially very different investors that they're targeting, so they can create these to best fit the needs of those markets. And this is just to show you what would happen when we're looking at these different tranches. So let's say that we have this subprime portfolio, and then they start taking all of these losses. People are no longer paying on these. So when we start looking at what's the impact, right? The mezzanine tranche, that's the one we were dealing with here, right? This mezzanine tranche, as these losses go up, you see at 10% of the total portfolio, the mezzanines lost 1/3, right? Because remember, that senior tranche, they're going to want to get paid first, right? So what ends up happening then is they lose 33% of the value, but they've got to disperse those losses. So what ends up happening is whenever these losses start to occur and that mezzanine tranche itself gets hit, that's this piece here, right? These people stop getting paid first, and then, it works its way back up. So if you notice here, the equity tranche, as we start taking these losses, that equity tranche, they stop being paid, right? And then as the losses get higher and higher, then that mezzanine tranche within of the collateralized debt obligation, within that larger mezzanine tranche, they stop getting paid as these losses continue to accrue. And then the last people that would be hurt are those people in the senior tranche, because that's why they're willing to accept less of a return, because as you can see, they're going to be safer as these defaults begin to happen. They're going to be the last to be impacted. And so if you're just trying to get a higher return, maybe you say, hey, I don't expect this to happen, and I want that, LIBOR plus, several percentage. I'm willing to risk this to get that higher return. So it's just different investors having different needs, and though we have different products made for them. This is to show what happened with U.S. real estate prices. So if you look at what has happened, you would see that once we began doing securitization in earnest, and this was after .com bubble and things like that, we were seeing investors that were wanting more and more investment opportunities, particularly things that spread risk out. And if you notice, housing prices just skyrocketed. This is what we call the housing bubble. This is, you see where real estate prices have an exponential curve, right? But then what happened was it eventually reached this peak. And then once people began defaulting, you saw home prices fall back down to more where they should be based upon what inflation would have been, right? So without the rampant buildup and then collapse, if you think about, just some sort of steady growth, this is more where we would expect just based on home growth. Okay, so what happened? So it started in 2000. Like I said, there was several things that were going on. You had a lot of capital coming in, and so the people were looking for ways to invest that. At the same time, we had a big push to try to increase home ownership, and so we were trying to get more and more loans out, particularly to low-income individuals, because home ownership was seen as a good, fast way to help people build wealth. We had really low interest rates, which made it really easy for people to buy homes. This also was the start of a lot of those home improvement shows where they would flip homes. So someone would go in and purchase a home and then redo the kitchen and the bathroom and then sell the home for more money. And you had this that was driving home prices up because, a lot of older housing stock was being refurbished, and then a lot of new stock was also being built. So there was this increase in production or manufacturing of homes, but it was not enough to keep up with this demand because there's so much capital flowing that way. So they were having to lower standards more and more, though, as this housing stock was starting to grow, because they just needed more and more people to get it. And so if you notice there, the 100% mortgages, ARMs, teaser rates, just to explain what these are. So 100% mortgage means like you would not need any down payment. We would give you a mortgage for 100% of the purchase price of the home, meaning you went into the house and you own nothing in the house, right? So you can imagine if you're going to walk away from a home, if you put no money into it, it's easier to do that, right? So these homes would be more likely to be abandoned. ARM is an adjustable rate mortgage, which means the rate looks really good now, but if interest rates start to go up, then it gets to be a lot more expensive because your rate would float up with it. When we're talking about swaps and changing from fixed to floating rates and floating to fixed, this is putting floating rates into home markets, and a lot of people have had fixed for a long time. Teaser rates were things where we would say, hey, I'm going to give you this just ridiculously good rate for the first 5 years, and then it goes up. And so a lot of people, they got lulled into this false sense of security because they had this low interest rate, and then when it jumped to where it should have been, they couldn't pay for it. Ninjas is no income, no job. So they had no proof of income and no proof of employment, but we still gave them loans. I know this sounds ridiculous, like as I'm saying it out loud, but if I'm going to put up a link, an announcement. I'll put up a couple of other videos where people go into it. It seems really strange to talk about, but it's just how it worked. But yeah, so they take all these mortgages, and then they would package them up, like we were saying, with those mezzanines or with those tranches, and then they were able to sell those to the investors, right? And they were able to buy exactly which mortgages, not the particular mortgage, but the income stream off of those mortgages that they wanted. Okay. And so since interest rates are so low, I could go take my money and park it at the Fed and get 1%, but I'd be better off investing in those AAA tranches because it would be more than I'm going to make from the Federal Reserve, and it's AAA rated. So, this is a really good, position to be in. But then as soon as, the houses start to, not be paid, right? Then once all that happens, they're not paying on it anymore. Then they just don't pay for the house. They just tell the bank you can have it. That's what happens when you're foreclosed, right? The bank takes your home as collateral to pay off the loan. But if you owe more than like the house is worth, it's better just to let them keep the house, right? I took out a loan for $300,000. The home value has fallen to $150,000. You take the house. I'll go move somewhere else. It did, yeah, of course, that's negative on my credit, but I'm not paying $150,000 for something that has no value, right? So, and so that's what ended up happening, where banks ended up with all these homes that they did not want. They wanted the cash, not the houses. And as more and more of these have to hit the market because the banks are trying to sell them off, that just further pushes down the value of the houses, right? So so what ended up happening is you start having this cascading effect where more and more cities just have everyone walk away from real estate. And so all of that suddenly becomes a very risky investment, which hits all these banks at the same time. So, and what was going on? One thing is these losses, normally we consider them to be uncorrelated, right? You go bankrupt or you cannot pay your mortgage. That has nothing to do with your neighbor. So we think of those as being unrelated events. However, as more and more defaults begin to happen, then we start seeing where they do feed upon each other, right? So there is this positive correlation, and the more strongly positively correlated that is, the worse it's going to get for us. Also, we expected to be able to recover money because we were going to take the home and resell it, and then we could, you know, if I foreclosed on your home because you didn't pay, but the home value is going up, I can turn around and sell it, pay off the mortgage, and I'm fine. But once the market gets stressed, I can't just do that. And then the other thing was we just looked at all the ratings and we treated them as they were the same. A AAA rated bond is the same as a AAA rated tranche, and that just wasn't the case. And so we weren't able to understand exactly how that risk stacked up. So, and then another aspect to this is the banks realized that they would be much better off securitizing as much as possible, because having these tranches of securitized assets allowed them to have much less in reserve. But as you can imagine, the reserve requirement is there for a purpose, you know, and a lot of it has to do with bank stability. And so banks got themselves in a position where they lost a lot of the capital that they would need. As far as some of the perverse incentives where this broke down, if you think about it from the mortgage originator, so this is a person that goes out and finds people to buy homes, right? Like that's what they're trying to do, is originate a mortgage, right? Create a mortgage where one wasn't before. And so they just want to create new loans. They don't really care what's going to end up happening to it in 2 years, right? They just want to get this loan sold because they've got their money up front. People that were doing valuation of homes, so the people that would come out and tell you, oh, this house is going to be worth this much on the market, they knew that they would get more business the higher they valued the home, right? By valuing it higher, banks like to send them because they can make bigger loans, right? And so that made these homes look better and better, right? And then the traders themselves, they're just moving stuff off their books. They don't really care about long-term implications. They're just trying to build a portfolio for today, and then they buy and sell pieces. So they're not incentivized to think at all about the long-term consequences of these. So what ended up happening? Well, it changed the way we view equity capital, right? So we were allowing them to hold a lot of things and counting it at 100% value when we probably shouldn't have. So we adjusted that. We also made them have more liquidity. They had a lot of assets that just were not able to be liquidated in a short period of time without incurring huge losses to the bank, which would trigger other issues. So, excuse me. And so what they were had to make those types of changes. We've already covered the central clearing houses for these types of derivatives. So that was a big change that came out of this. Europe made different changes than the United States. So they were able to do a lot of things that limited bonuses. In the US, employment law doesn't always allow for the same type of changes. So, but one of the things that did happen across both systems was changing how bonuses are paid to stretch those out over multiple years, in the sense that if you are concerned about your bonus in 5 years, you're going to make decisions that will have a longer horizon. And then we also limited the amount of proprietary trading that's trading within your own house, right? So we made restrictions around that. So look for an announcement. Actually, if you see this video, I probably already made the announcement. But I'm going to put up a couple of other videos that explain this in a bit more detail. Well, not more detail, well, somewhat, but it's more. One of them is like a dramatization. And so it lets you understand how pervasive this got, because once it started working its way through the entire financial system, everybody involved in the financial system was involved, even if they did not directly buy any of these investments. So